Welcome everyone. It is a beautiful day in a mystery location we'll talk about in a second, but today we're going to dive into a subject about a little known way that US companies, Americans included, can have a 37.5% reduction in their corporate tax, paying just 13.125% tax. So this is something that I even didn't know until a couple years after it was introduced. This is, one of the problems with the American tax system. It is convoluted and has lots of different things, but I'm going to explain what this is, how it works, whether you can take advantage of it, why it exists, how it compares to some of the other options out there from the standpoint of US companies, and dive in accordingly. So let's get started. Before we do, welcome. We are here in, as I said, a mystery destination. So we're going to play a little game of Where is Michael? I will kind of show you guys a little bit. I've kind of chosen this square not to be too overt about where it is. There are some little clues there, but you can pick and guess where exactly in the world I am, and put it in the comments below, and then in the next video I will describe where I am and we will kind of go accordingly. So let's do that. Now, so we're here talking about international tax, which is kind of our area of expertise, and so a lot of our clients are Americans, although we have people from all over the world. And so in particular for Americans, there are a whole bunch of anti-avoidance rules, and these are typically Subpart F of the US tax code, which generally speaking, we're talking about something called foreign-based company sales income, foreign-based company services income, but also GILTI tax, which came into effect with the Tax Cuts and Jobs Act. Now at the time, they introduced a participation exemption, which allowed us to go and to have some ability to repatriate dividends into the US tax-free. And so that was pretty good. And so very, very commonly, one of the things that we're setting up for Americans is to utilize this thing where you can basically cut the corporate tax rate in half. Now, there's a whole bunch of limitations on whether you can do that or not. Like I said, you have to worry about all these other rules. And the way that you do that essentially is you have a US C-corp. The C-corp owns a foreign company. A bunch of things have to be true. The foreign company makes the money. It pays hopefully no tax. It gets hit with GILTI tax, and so you're at 10.5%. Now, this has got a whole bunch of hassles associated with it in terms of having a foreign company and running the income through a foreign company. There might be a bunch of reasons why you don't want to do that, etc. And so it's worth noting that at the time when they introduced all of this, they also introduced something called the Foreign Derived Intangible Income, FDII regime. And so the FDII regime was set up essentially to allow you to have, in many cases, the same or very similar benefits that you would get from something like this structure that I'm mentioning, but without having to do that structure. And this was relevant because when they introduced GILTI tax, what they said was, say you form a company in another country, you have a subsidiary there, you will get a tax credit against your GILTI tax for 80% of the taxes paid domestically. And so if you do the math, what this works out to being is that if you were to actually have had tax at, let's say, 10.5% or whatever, you basically, you get to the stage where your effective total tax can be up to a little over 13%, okay? And so they said, well, listen, if people are going to do that anyway, and they're going to have assets outside of the US, they're going to have staff outside of the US, etc., wouldn't it be just much easier if we allowed them to keep that stuff in the US, right? That's the whole point of these particular regimes. And as a result, this was this FDII regime. Now, how does this regime work? This regime has a bunch of limitations. It is in cases where you have a US company, and the US company can have all US operations, so that's very cool. It is utilizing IP that is held in the US, but it is selling to foreign customers. So the little bit of a difference here, and if you want kind of, the stuff that I'm talking about here is high level, and so everything should be personalized to you. So if you want help with that, reach out to us, book a call with me. I can go through all the details with you, or you can send a message through offshorecitizen.net, send us an email. So anyway, just kind of caveating that. But what would happen is that you'd have a US company, you would be selling to foreigners, you could have US operations, you would have US based IP, and they will allow you on that to get this 37.5% reduction from the normal 21% corporate tax rate in the US, and effectively end up with 13.125 tax. So what's the advantage of that? What's an advantage of the fact that you can have everything in the US? It's super simple, etc. You don't have to kind of worry about, do I trigger subpart F rules? Do I trigger PFIC rules? Do I, all this other stuff, right? But what is the trade-off? Well, if you do the other way, the way that we often do for clients, then the benefit is you can potentially sell to Americans. So this has the limitation that you're basically not selling to Americans. Sometimes maybe that's okay for you, but it is in theory possible to do the opposite. Now again, caveating that by saying you have to worry about all these subpart F rules and making things work accordingly, but it is an option. And so for some people, this is really quite attractive because a lot of people don't want a more complex setup, right? They don't want to say, okay, well, if I have a foreign company, then the foreign company needs to have foreign operations. For those who aren't familiar with how foreign-based company sales and foreign-based company services income work, those can get triggered in some weird situations. Maybe I have to make sure that I'm not doing activity in the US, or I can trigger permanent establishment rules in the US. That's not very cool, right? This puts all that aside, and just allows you to have close to or the same as you would have if you were to operate through a foreign legal entity. So anyway, that's the high level of it. I'm not going to get into too much detail on this video because, as I said, these things are very specific to the particular company. If you want help, you should reach out to us and we can kind of go over how it applies to your specific situation. I will kind of guide you on what works best for you. Our team will do a very detailed analysis and we can help you set it up, etc., whether it's domestically or abroad, as well as other strategies that might be better in terms of deferral, etc. But I figured I would raise it for you and bring it up because there are a lot of people who don't understand the options that they have domestically. Obviously, this can be paired, any of these, with something like the foreign earned income exclusion for Americans, etc. Now, the last thing I will say, though, is for people who are not Americans, does this make sense? Often we want to use stuff like US LLCs. This is not a replacement really for that because that's a very different situation. You do end up being hit with dividend withholding taxes, taking the money out of the country. So I would say usually for non-Americans, this is not a great way to go. But if you're an American, then certain businesses at least can benefit quite a lot. So hope that helps, and I look forward to seeing you on the next video.